everybody. Welcome to our presentation on S&P 500 Index Closing Code Prediction under the guidance of Dr. Brian Hammer. This is Shruti from Management Information Systems.
And I'm Harshada Oyuri from Management Information Systems.
I'm Siddhartha from Management Information Systems. We would like to thank our professor Dr. Brian Hammer, without whom it wouldn't be possible.
Let us start off with the agenda for today's presentation. We would like to discuss the following topics: the objective, methodology, scope, followed by the data preparation, exploration, modeling techniques employed, results and assessment, followed by the expected versus actual product, also the lessons learned during the course of the project, and the future scope, which could be extended to this project. Starting off with the objective of our project, we would like to predict the monthly average closing stock quote of S&P 500 index. So how are we going to do this? We are going to analyze the past history to identify the effect of commodities, exchange rates, interest rates, and market sentiment on S&P 500 index. But why are we doing this? So we would like to predict the monthly average closing quote of S&P 500 index because stock markets and stock indices represent the financial health of the industry in which an investor has made his investment. So why not just assess the kind of investments an investor makes, and so that we can observe the fluctuations in the indices and suggest the investor to reassess his portfolio, and so that he could manage his investments to maximize returns. So moving on to the methodology we have employed is the CRISP DM. So we would like to start off with the basic business understanding, which we have just discussed in our objective, followed by the data understanding and data preparation, which is then followed by modeling, evaluation of the modeling techniques employed, and finally the deployment. So talking about the scope of our project, we have started off with the Standard & Poor's 500 stock index. So we have taken into account the different quantitative factors affecting the market, and our data constitutes of the monthly stock data starting from January 2000 to October 2016. So we have data for Jan 2000, Feb 2000, March 2000, and it goes on like until October 2016. So what's out of scope? I mean, what have we not considered? So we have not considered data that's prior to 2000, and we have not considered daily stock quotes data because the markets are closed on Saturday and Sunday. And so what have we done for our data preparation? So we have collected the data, that was data access, followed by some consolidation, cleaning, transformation, and reduction. Starting off with the data access, we have collected our data from two major websites. One was Yahoo Finance and Investing.com. These are the major providers of financial news, their stock quotes data, and the various financial reports. So we've collected a variety of websites. So as we see, we collected S&P 500 quotes, volatility index, Nasdaq composite, and 10-year treasury note interest rates from Yahoo Finance. Whereas from investing.com, we collected crude oil prices, Euro USD exchange rate, and the gold prices. Every variable had the open, high, low, and close, which represented the average quotes for each month. So every variable was extracted separately. So we had like 1, 2, 3, 4, 5, 6, 7. We had 7 Excel spreadsheets. So what we did was we used R and consolidated all the spreadsheets into one Excel file using the R software. So now that our data was ready, we just moved on to data cleaning. One wonderful aspect of our data was that we didn't have any missing values. There were no anomalies in the data types after reading the data because date was read as date type, and the rest, all the variables are of numeric nature. So everything was quantitative, so the data was actually perfect. So no type conversion was required. Now that we have gone through data access and data cleaning, let's now move on to data transformation. So when we plotted box plots for all the variables in our data, we observed that volatility index and S&P 500 volume variables were having some outliers. So what we did was we performed a mean imputation on those particular observations so that our data was fairly normal. Followed Followed by data transformation, we have data reduction. So if you have observed, for every variable we had open, high, low, close. If we look at the data, all the four variables are almost close enough. So there was a necessity for us to perform some data reduction. So when it comes to data reduction, the best technique is probably principal component analysis followed by factor analysis, and this was best suited to our data. So what we did was we just divided the data into two equal halves, because we should not run principal component analysis and factor analysis and this on the same data. So what we did was we just split them into half, and then when we ran principal component analysis, we observed that there were four components in our data which were very significant, but we didn't know what those four components were made of. So what we did was we ran a factor analysis, and then it turned out to be true, and it was actually aligned to the PCA analysis. So we got four factors, and factor 1 was composed of exchange rate and crude oil prices, whereas factor 2 was composed of 10-year interest rate and gold prices. Factor 3 was made of Nasdaq Composite Code, and factor 4 was volatility index. Following data reduction, we were trying to perform some descriptive statistics on our data to analyze patterns as a part of our data exploration stage. So we have used R and Tableau to perform this analysis to choose our modeling techniques and find the anomalies in our data. So here are some graphs from our data exploration phase. We can see that the top left graph is the crude oil graph with respect to the date starting from Jan 2000 to October 2016. We can see that there is a sharp rise and fall in 2008. That is because of the global financial crisis. Now let's see the Euro USD exchange rate graph. This is kind of stable when compared to the crude oil prices. The overall trend seems to be increasing with some highs and lows. Here are some more graphs. The left one is the S&P closing price. That is what we are going to analyze. This is somewhat close to Nasdaq because both are market indicators. And the top right one is 10-year interest rate graph. If we can say that it's fairly decreasing all through the years. And the bottom graph is the volatility index. This was kind of tricky when we performed the box plots because there were a lot of outliers for which we performed mean imputation. So we can see that in 2009 the volume was at its peak, and then it was at its low at the same time. So we can say that there was a lot of turmoil in the market, and there was uncertainty which made a lot of investors to think about the investments. They were investing, they were pulling out, so there was basically confusion and havoc. So volume is one important criteria. So VIX is nothing but volatility index, which represents the volume. The next part of the presentation is data modeling, and this will be continued by my teammate Harshada Vuyuri.
Hello, I'm Harshada. Now let's look at the data modeling of this project. First comes the data splitting. So our data consists of records from January 2000 to October 2016 in a monthly frequency. Since it is in a structured format, which is time sensitive, we had to follow the first N sampling technique for splitting our data. So we took the data from Jan 2000 to December 2014 for building our models, whereas we took the data from Jan 2015 to October 2016 for testing those models. So next is the modeling techniques. Based on our exploratory analysis and the type of variables we have in our data, we rounded off on 3 models. Since our target variable as well as the predictor variables are continuous in nature, we chose linear regression, which is the most commonly used technique for such kind of variables. The next is the neural network. It is a most powerful computational model which helps us find the relation between the input and the output variables by processing them through a network. And the third is ARIMA, which is autoregressive integrated moving averages technique. Since our data is time dependent, this model would be apt for our data. Moving on. So the first model is linear regression. Through regression, we aim to find the relation between a target variable, that is the S&P 500 closing price, with that of volatility index, which is a market sentiment indicator, and then the Euro USD exchange rate, which gives us the value of US dollar in the global economy. Then the gold and crude oil prices, and the US 10-year treasury note interest rates. In order to build the regression model, we first had to check whether the regression assumptions were satisfied by our data. We ran a number of tests for checking the linearity, correlation, homoscedasticity, independence of residuals, and normality of the variables in our data. Of these assumptions, as you can see in this table, all the assumptions except for the independence of residuals are satisfied. Since the independence of residuals has failed, we cannot run regression on the current data that we have. Also, this indicates there might be an autocorrelation between the data points we have, because the independence of residuals is not present. Moving on, the next model is neural networks. These neural networks can be applied to linear as well as the non-linear data, as they do not have any assumptions to be fulfilled. It is suitable for predicting the data by training the algorithm through the data that we have, and it calculates the weights depending on that, which helps us in forecasting. So through neural network, we wanted to find the average closing price by feeding the input factors and adjusting the weights by training the network. So we ran the neural network with the target variable as S&P closing price, and the predictor variables being the factors, which included the euro and crude oil rate, the 10-year bond and the gold price together, the Nasdaq as a factor, and the VIX, that is the volatility index, as a factor. We ran the neural network through R, and after the trial and error method, the ideal network we got finally was the network that had 2 hidden layers consisting of 4 and 3 neurons respectively. In the figure here, you can see the neurons, the neural network with neurons and their calculated weights respectively, and the lines in the network, they are proportional to the weights of those neurons. So thicker the line, higher is the weight of that particular neuron. So through this neural network figure, we found out that the Euro USD rate and the crude oil price were the most significant ones to determine the S&P closing price, which was then followed by Nasdaq and the volatility index. According to our neural network model, the 10-year treasury note interest rates and the gold price were not significant. Moving forward, the next model is ARIMA. Since our data is autocorrelated, ARIMA is apt for forecasting, as it uses the past values as series along with the predictor variables to help build a model to predict the data. And that is what we aimed at, predicting our test data from January 2015 to October 2016. Here the figure shows the S&P closing price against time. It exhibits seasonality and irregularities, giving rise to a doubt that autocorrelation might be present in the data. This doubt is further confirmed with the ACF and the PACF graphs. Through these graphs, we see that the present values are dependent on the previous values. Thus, there is a significant correlation between the present and the previous values, which is actually termed as autocorrelation. So for building our ARIMA model, we used the variable factors Euro crude oil, the 10YB with gold, Nasdaq and VIX as predictors or regressors, and the time ID as date with an interval period of 12 since our data has a monthly frequency. So these are the plots that we got after running this ARIMA model. And here if you see the ACF and the PACF plots, they seem to be flat, adjusting to the autocorrelation that we earlier saw in our data. And the next is the forecast plot, which compares the actual versus the predicted values, and we don't see many deviations here through this plot. Moving forward, the table here shows the actual and the predicted values for the term Jan 2015 to October 2016. And if you go through each of the actual and the predicted values, you'll see that each actual value is within 95% confidence interval, each of the predicted values. And the graph here gives the blue line gives the forecasted value and the red line represents the actual value. There are a little deviations, but then the model looks fair. So through ARIMA, the inference that we got is that Nasdaq and Euro crude oil are two important regressors in predicting the S&P closing price, and the other two, the volatility index and the 10-year bond interest rate or the gold rate, are not very significant. Moving on, so results and assessment will be handled by my teammate Sidhu Totapura. Thank you.
We have chosen root mean square error as the assessment metric to compare models. It is the measure of difference between the values predicted and the values actually observed. Although we have considered 3 models for our analysis, we ended up with 2 models, neural networks and ARIMA. We eliminated linear regression due to violation of assumptions. Now let us discuss the strengths and weaknesses of each of our modeling techniques. Neural network is a robust modeling technique and has the ability to learn and get familiar with the initial training data supplied to it. The biggest weakness of a neural network is it is a black box model. Since the results from this model are estimations based on the initial dataset supplied to the network, errors are inevitable even after undergoing multiple number of iterations. ARIMA's biggest strength is to perform regression with nonlinear data. Let us now compare the model parameters for each of the models. Given such a huge range and volume of data, the root mean square error and mean absolute error values of both the models seem reasonable and commendable enough. However, both the parameters root mean square error and mean absolute errors suggest that ARIMA is a better model when compared to neural network. Hence, considering all the above factors, ARIMA model is best for interpreting the effects of independent variables on the target variable and is considered superior in terms of root mean square error. Expected versus actual. Our original vision was to predict the daily closing quote of S&P 500 index. But given the complexities in dealing with Saturdays, Sundays and holidays, we had to narrow down our scope and choose to predict the monthly average closing quote of S&P 500 index. We predicted the monthly average closing quote of S&P 500 index using the crude oil prices, volatility index, Nasdaq, 10-year treasury note interest rates, euro and USD dollar exchange rate and gold. Lessons learned. Data preparation is the most important step in the CRISP-DM methodology. Good domain knowledge and business understanding is necessary for the success of project. While performing our analysis, we should be observant and open to the patterns hidden in the data rather than frantically run behind our motive. Future scope. We have narrowed down our analysis considering only monthly data. With quotes of daily frequency and appropriate data manipulations, we can analyze at a more comprehensive level. We can also perform text mining if qualitative data is taken into consideration. Thank you. We are open for any queries and suggestions.